So Discovery's got this product called a endowment policy. And basically what it is, it's a discretionary savings vehicle for either lump sums or recurring premium. And the reason why there is so much fuss around this product is for its inherent tax benefits. It is a product that caters to wealthier individuals that are in a higher income tax bracket. Basically, those investing in an endowment policy pay a flat rate of tax. Another benefit of the product is that you could basically have it in your personal capacity as a natural person. A company can own it via our lump sum or recurring corporate endowments. And these products can also be housed in a trust. Now, for a trust, an endowment almost seems like a proverbial no-brainer, purely because of the tax treatment that the endowment policy enjoys inside of the trust. So, further to that, Discovery makes investing in endowment policies a little bit more, shall we say, interesting. We offer a element that the rest of the market cannot offer. That is the element of integration. Integration is a very, very interesting product concept. Basically, I like to think of it as a facility that creates a net credit in your investment. What do I mean by net credit? Well, basically, when you invest, you pay fees and you pay tax. Doesn't matter where you go, you will end up paying fees and tax in any investment product. Same with Discovery. However, Discovery has this anomaly called integration, and the way in which integration works for lump sum endowments is we offer a boost. Okay, that boost is basically determined on a couple of factors. First being whether or not the investor has a Discovery life policy, and whether or not the investor is comfortable investing in Discovery funds. Best case being you have a life policy and you don't mind Discovery funds. This gives you a bigger boost, but you will still get a boost for having no life policy and being happy with Discovery funds, and you will still get a boost for having no life policy and investing in external funds. The benefit of this boost is it is a tax asset. In other words, it is a completely tax-free sum of money that basically accrues to you in years 5 and 10 of the investment. The way in which the boost works is that it is an upfront boost on the initial value of the investment. At base, no life policy with Discovery funds, we can offer you a 14% boost upfront. That boost grows at a fixed rate of 6% per annum. Half of it pays out in year 5 tax-free. The remaining half sits behind in the investment, grows at a further 6% per annum, and pays out in full tax-free in year 10. Now, to the untrained ear or eye, this may seem like a wonderful gimmick, but I can assure you it's not. It is a very, very interesting proposition. Basically, this boost caters for pretty much a majority of the cost, depending on how costs are taken in this policy. And it also has the opportunity to take care of the tax that gets paid in this investment. What does that mean to the average man on the street? It basically means that the investor will enjoy a higher return, net of tax and costs, on a relative basis when compared with a competing offering out there in the industry. So much so that in many cases, the costs are covered in full, and the investor is actually left with a net credit in the investment. And this is something that I refer to as a bankable alpha, or a bankable return. This idea of a bankable return is actually quite interesting because it creates the facility for certainty in an uncertain environment. Certainty of return is something that other providers can't necessarily get their heads around because the market is uncertain. But we find at Discovery, at product level, we can create a tremendous amount of value at product level that basically facilitates a lot of certainty in the environment. Certainty that my costs are going to be met, and certainty that some of the tax will also be covered. Obviously, the variables for consideration as to how much tax and how much cost gets funded by these boosts is entirely up to the size of the life policy, entirely up to Discovery Fund representation, and also up to how much commission your advisor is actually taking in this product. There is also the opportunity to invest on a recurring basis in an endowment policy. The structure remains the same in terms of tax, but the costs are different. Depending on how the advisor chooses to remunerate themselves will determine the admin fee that Discovery Invest charges the investor. Investors can take commission in two ways, either the legislated upfront commuted advice fee or on an as and when structure. The as and when structure is preferable for investors that favor flexibility, purely because if the investor chooses to decrease premium, they can do so without penalty. However, that facility is also available to investors that are on the upfront commission structure. If the advisor and the investor come to the agreement that they are happy to take a reduction in advice fees on the upfront commuted structure of 50%, Discovery Invest will waive any penalties to that client or investor should they have to change terms of the agreement in terms of taking a withdrawal, decreasing premium, or stopping the investment. And whilst I'm on that subject, I should maybe make this point known. With Discovery Invest, in an endowment policy, it is a product that is subject to legislation. You are only allowed one withdrawal with Discovery in this product. It can either be a part surrender or a full withdrawal from the investment. Bear in mind that should you choose to action this facility, 5% of the initial investment amount has to sit behind, and you will be entitled to that after 5 years. So we can see by this that this endowment policy really is a longer-term investment product. It is not a product for investors that need access to liquidity in the short term. It is really a product that is in place to facilitate growth of wealth over the long term. After 5 years, this endowment policy becomes what we refer to in the industry as a matured endowment, meaning that it is now openly accessible to the investor. Investors may send instructions to Discovery Invest to do monthly withdrawals from their matured endowments, or on an as and when basis choose to access money freely by filling out some paperwork and submitting it to our servicing department. Why is this interesting? Or why is this a point that pays mentioning? Purely because the tax in this endowment policy, as I mentioned in the beginning, is happening inside of the investment, which means whatever withdrawals you take into your bank accounts are after-tax withdrawals, or how we say, tax neutral. This makes this endowment policy really tax efficient if you think about it. If we have an investor in this product that is being taxed at a higher marginal tax rate than an effective 30%, that means that they will effectively benefit from superior tax treatment. It also means that if they use this product later on in their life, when they start getting closer to retirement, any withdrawals they take on a monthly basis from this product in its matured format or as a matured endowment will be treated as tax-exempt money. So you can see quite easily that if I'm drawing money from a linked annuity or a fixed annuity in retirement, and I'm drawing money from my endowment policy, the money I draw from my endowment policy is effectively not taxed. That means that I can draw less from the taxable source, which is my linked annuity, and cross-subsidize my income requirement from a tax-free source, effectively, thereby paying less tax whilst not impacting my living standards in any way. What happens on death? Well, money in endowment policy basically pays directly to a beneficiary. This means that it isn't really touched at all by the executor and therefore doesn't attract executor's fees. But you will still pay estate duty. Discovery also makes this product available to businesses. Corporate investors can access either a recurring or lump sum endowment, and if they access the lump sum endowment, they will effectively be able to invest at zero tax. Investment integration basically translates to a zero tax corporate endowment through just accessing Discovery funds. This is quite significant because companies pay large amounts of tax on the growth of their assets, whether it be in a bank account or with an investment management firm. Discovery Invest effectively allows these corporates to access tax-free growth on their savings if they are able to commit to a 5-year term. But what about having money in endowments in the hands of the business owners? Business owners generally run the risk of their business going bust. If this happens, that business owner could be liable for payments to their creditors. Having money in an endowment policy basically frees a business owner from creditor attachment. Should that money be in the endowment policy for 3 years, and this business owner happens to become sequestrated, the money in the endowment policy is protected from his or her creditors. This feature is a feature that is available to any investor in an endowment policy. And like I said, the money has to be invested for 3 years. Further to this, once the money is paid out from the endowment policy into the investor's bank account, a further 5 years have to lapse before creditors may attach that money. So as you can see, endowment policies are really interesting, really useful, long-term savings vehicles that offer the investors possibilities of paying lower tax, investing with Discovery at zero tax, effectively, at zero fees, whilst growing the investment to such a point where they can actually realize tax-neutral withdrawals. I hope this has been informative, and I thank you for your time.